Hello and welcome to the Countdown to the TILA RESPA Integrated Disclosure Rule webinar. This is a readiness roadmap for mortgage professionals, and it is presented by Morph Media and the Morph Learning System. I want to thank you for joining us and welcome you to the webinar today. My name is Ginger Bell, and I'm an education specialist in the mortgage industry. I will be sharing information on the new TILA RESPA Integrated Disclosure changes. The goal for today's session is to provide you with an overview of the changes that are coming that will help to keep your transactions on track. And I'm going to begin with a review of what we'll be covering in our session today. We'll begin with an overview of the new rule. We'll talk about mortgage brokers and disclosures and what they can do. We'll also talk about pre-application, application, changes as far as imposing fees, the timing requirements of the new disclosure, as well as waiting periods. We'll get into business day definitions, the definition of consummation, and we'll talk about tolerances or variances, as they're now called, and then discuss some planning and action items. I also want everyone to know that this webinar was recorded prior to the recent announcement from the CFPB of an extended implementation period from August 1st to October 3rd. So the references made throughout this recording that speak to an August 1st implementation, know that that date is being delayed to October 3rd. So important to note that the changes that are happening for TILA RESPA will be delayed until October 3rd of 2013. So we're going to be looking at all applications on or after October 3rd. So carry on with the webinar, and please note that references to August 1st will now be noted to October 3rd. So thanks to the Dodd-Frank Wall Street Reform and Consumer Protection Act, HUD and the Federal Reserve have gotten on the same page. The new disclosure shows buyers what cash they need to close, credits from the seller and the lender, and an understandable comparison of what disclosed costs are from the beginning to the very end of the transaction. So the CFPB was responsible for engaging both consumers and industry for research and input on the new forms. Once the research was completed, the CFPB conducted analysis of public comment and outreach for more than a year. The CFPB also conducted a large-scale quantitative study of its proposed integrated disclosures with approximately 850 consumers. The CFPB finalized the rule with new integrated disclosures, and it's the Integrated Mortgage Disclosure under the Real Estate Settlement Procedure Act, or Reg X, and the Truth in Lending Act, Reg Z. The TILA RESPA rule also explains how the forms should be filled out as well as used. So the forms that we use today are existing forms, a good faith estimate, or the GFE, and the initial TIL, which are issued at application, and then the final TIL and the HUD-1 settlement statement, which are issued at closing. The new disclosures are the new loan estimate and the closing disclosure. So the GFE and the initial TIL now become the loan estimate, and the HUD-1 and the final TIL now become the closing disclosure. This is for applications taken on or after August 1st of 2015. So the new loan estimate and closing disclosure forms cannot be used prior to August 1st, and this means that until August 1st, lenders will continue to use the old forms for all applications. So the new loan estimate combines the initial TIL and the GFE. It consists of 3 pages. The loan estimate is issued within 3 business days of application, and both mortgage brokers and lenders can issue the initial loan estimate. The closing disclosure combines the final TIL and the loan estimate, and it consists of 5 pages. Lenders may issue the closing disclosure, and it must be received by the borrower 3 business days prior to consummation. There are defined business day rules for both the initial loan estimate and the closing disclosure, and we'll cover those later in the webinar. There are also tolerances for changes in fees from the loan estimate and the closing disclosure. So to view the new proposed mortgage disclosures, you can visit the Consumer Financial Protection Bureau's homepage at the CFPB and scroll down to the Participate tab and then select the drop-down for mortgages. And also the CFPB has issued a very detailed 96-page explanation of the new forms, which can be viewed online at the guide to the new loan estimates and closing disclosures. So the new regulation covers typical mortgage loans for purchase, refinance, home equity loans, or second mortgages, not including HELOCs. So this means that the new forms will be used for all closed-end consumer purpose mortgage loans, except for reverse mortgage loans and HELOCs and properties not secured by land. This does not include commercial loans. So obviously if your client is doing an owner-occupied VA loan, then you'll be using the new forms. If they're doing a jumbo conforming condo loan, then you'll be using the new forms. Or if you're doing a USDA loan, then you'll be using the new forms. Also, the new disclosures will not be used for reverse mortgages, for HELOCs, and for homes not secured by property. So they will continue to use the old forms, and all other loans will use the new forms. So it doesn't matter if the application is for a construction loan, a lot loan, or a hard money loan. All consumer purpose mortgage loans, except for those listed above, and commercial loans will use the new forms. And that's for all applications taken on or after August 1st. So a couple of important highlights. First of all, the new loan estimate has a signature line on it. However, the borrower is not required to sign it. The lender or the broker can provide the loan estimate to the borrower. And if the broker is completing the loan estimate, and then they can leave the creditor name and the loan number blank until they decide who to send it to. Now, it's important for any loans that you are brokering to make sure and work with your lender to find out what their process is as far as allowing brokers to complete loan estimates, submit loan estimates in the process. There's also a new category which is called TIP, or total interest payment, and this replaces the total payments from the initial TIL. It shows the total amount of interest rate that the consumer will pay over the life of the loan. And yes, it is a big number, so you'll want to be sure to cover what it is with your borrower. Additionally, the APR is still included. It also, in the loan estimate, shows what they'll be paying at year 5 of the loan. Another important area, and we'll talk in detail about this in a little bit, is you cannot impose a fee other than a reasonable fee for a credit report, and you cannot require additional information until the borrower has received the loan estimate. So you can ask for additional information, you just cannot require additional information. So as I said, the old forms are not completely gone. We will still use the GFE, the TIL, and the HUD-1 on HELOCs and reverse mortgages and properties that are not secured by land. So let's talk about pre-application. Prior to receiving the 6 specific items of information, lenders may provide consumers with written estimates, but any pre-application written estimate must contain a disclaimer that it is not an official loan estimate. And next we'll move on to application. So the lender or the broker must provide the loan estimate within 3 business days of a loan application being submitted, even if it is not a formal written application. So this means even if you take an application online, over the phone, on a napkin, on Facebook, whatever it is, as long as you have the 6 items, then you have to issue a loan estimate within 3 business days. And this part is nothing different than where we're at today on the GFE. But let's talk about the 6 items for application, because this is different. In the existing RESPA rule, there's a 7th item as far as definition of application, and now we've gone to a hard 6 items. So once you have these 6 items, I like to use the acronym ALIEN, and it's easier to remember those 6 items that way. So it's address, loan amount, income, estimated value of the property, name, and social security number. Overall, the loan estimate is intended to give consumers more helpful information about the features, the costs, and the risks of the loan that they are applying for. So next we'll move on to imposing fees. I spoke briefly about that a few slides. It's important to remember that you cannot impose any fee on a consumer except for a reasonable fee for the credit report before the consumer has received the loan estimate and indicated an intent to proceed with the transaction. So that's important. They need to tell you they're ready to go. The TILA RESPA rule includes some new restrictions on certain activity prior to a consumer's receipt of the loan estimate, and the restrictions take effect on the calendar date of August 1st, 2015, regardless of whether an application has been received on that date. These activities include imposing a fee on a consumer before the consumer has received the loan estimate and indicated an intent to proceed with the transaction. So this means that you cannot take their credit card number or take a post-dated check for things like the appraisal prior to the consumer receiving the loan estimate and indicating an intent to proceed. This also means that you cannot order the appraisal with your own credit card prior to the consumer receiving the loan estimate and indicating an intent to proceed with the transaction. Now, obviously, you're going to take the credit card information in order to pull their credit, but you just cannot intend to impose a fee like the appraisal, which is most common, until they have let you know that they are ready to go. So a consumer can actually inform you in any manner that they are ready to proceed on the loan. So it can be by phone, it can be by email, it can be in writing, but you need to have the confirmation from them before you get the credit card or the check for anything other than the credit report. And remember, the credit report fee must also be considered reasonable. So it's important to be able to set up an effective tracking system so you can keep track of everything that's happening, when the loan estimate was sent, when they received it, when they've given their intent that they want to proceed, and then when you have gone and charged for other items like the appraisal. It's important to put together a tracking system in order to track all of those. And also it's important to remember that the loan estimate, although it has a signature line on it now, by law the borrower is not required to sign it. But it's important for you to set up your own policies and procedures and processes as to how you're going to take that intention to proceed from the consumer. So let's move on to timing. There's much to cover under timing requirements with all the changes, and we're going to begin with the loan estimate. So the loan estimate must be provided to the consumer within 3 business days after the lender or the broker receives the consumer's application for the loan, but no later than 7 business days before consummation of the transaction. For revised loan estimates, revised loan estimate or a final loan estimate must be received by the borrower 4 business days prior to consummation. And if you're mailing the revised loan estimate, you must allow an additional 3 business days for delivery of the revised loan estimate. However, if you have evidence that the revised loan estimate, and this is in particular on obviously the final loan estimate, if you have evidence that it's been received by the borrower, then you may use the date as the date received by the borrower and then begin counting those 4 business days. So for the definition of consummation, a transaction is consummated when the consumer becomes contractually obligated to a creditor. And state law prevails in this area, so you'll want to follow the definition of your state for the definition of consummation. And we'll go into a little more detail on consummation a little bit. Let's talk about change of circumstance. We're used to this on the GFE, so if something changes, then you have to redisclose within 3 business days of receiving the information that would cause a revision. So nothing new as far as that requirement that we have. One of the biggest changes that the industry will be affected by is the closing disclosure timing. So the closing disclosure must be received by the borrower 3 business days prior to consummation, and it's important to be aware that there is a 3 business day waiting period. So this means that the lender must get the closing disclosure into the borrower's hands 3 business days before consummation. And those 3 business days are specific business days, which is every day except Sundays and U.S. holidays. And we'll talk about that in more detail in a little bit. But it's important to remember that it's the date received on the closing disclosure. So let's talk about those business days. So definition of business days for the loan estimate is similar to what we have for the GFE right now. So this is loan estimate definition is a business day that is any day in which the creditor is open to the public for carrying out substantially all of its business functions. So if an application is denied or withdrawn during the 3 business day period, then you do not need to provide the consumer with the disclosure. However, if they amend the application, the timeline is reset and the 3 business day period begins to run from the amended application. So As far as brokers, it's important for you to work with your wholesale lenders to find out what their definition of business day, because this does not apply to your definition of business day, because it's the definition for the creditor, which for brokers, that definition is your wholesale lender. And so most wholesale lenders, Monday through Friday, so those are the business days that you'll be counting, not the business days that you're open. For creditors, or for correspondents, or for mini-core and non-delegated correspondents, then those are the days that you're open. So this is for the definition of the loan estimate and the loan estimate only, so it's for sending the initial. Let's talk about after the initial loan estimate. Then we get into the definition of business day, and this relates to the closing disclosure. So there are two definitions for the new disclosures. So obviously we have the loan estimate definition, and then we have the closing disclosure. And that definition is a business day. For this and any other purposes in the regulation is all calendar days except for Sundays and legal public holidays. And so the biggest distinction between the two on the loan estimate and the closing disclosure is that for the closing disclosure, Saturday is considered a business day, even though your wholesale lender may not be open, or even though you as a correspondent may be open. This is similar to what we're used to in counting our rescission period. And so that's our definition of business days for both the loan estimate and closing disclosure. So now let's talk about waiting periods. So we talked a little bit about the revised loan estimate, and there's a 4 business day waiting period for revised final loan estimates. And if a revised loan estimate is generated, then it must be received by the borrower 4 business days prior to consummation. And if mailing the revised loan estimate, you must allow for an additional 3 business days for delivery of the revised loan estimate. However, if you do have evidence that they received the loan estimate, whether it's by overnight a signature, or whether it's an electronic disclosure signature, read receipt is not enough on an email. So you need to make sure that you have either a signature, you've given it to in person, or you're using a secure disclosure method, and there's systems out there to do that. And so that's for the loan estimate. For the closing disclosure, there's a 3 business day requirement. So the borrower must receive the closing disclosure 3 business days prior to consummation. And again, this talks about receive. So it's a matter of they have to receive either the loan estimate, the final revised loan estimate, 4 business days prior to consummation, and then they must receive the closing disclosure 3 business days prior to consummation. So we know changes happen on the HUD and the final TIL, and the same thing I'm sure will happen on the closing disclosure. So you can make changes to the closing disclosure. Once it's out, that's fine. You do not have to start a 3-day waiting period unless one of these 3 events occur. So if one of these 3 items occur, then a new waiting period for the closing disclosure begins again. And so there are these 3 evidence that involve changes to the closing disclosure that will require a new waiting period. And the first one is if the APR, annual percentage rate, becomes inaccurate. So if the lender makes changes to the APR that's greater than 1/8 of a percentage for most loans and 1/4 of a percentage for loans with irregular payments or periods, then it would trigger a new 3-day waiting period. And again, that's from the day that the consumer receives it. So from the day the borrower receives that new closing disclosure, a new 3-day period. That's the first thing. The second thing is if the loan product changes. So if the loan product changes, generally payment features, if they go to an ARM, if they change loan programs completely, then there's a new 3-day waiting period. And then if there's a prepayment penalty that's added, it could also trigger a new 3-day waiting period. So these are 3 items. Again, you can make changes to the closing disclosure. You cannot make changes to the final loan estimate once the closing disclosure has been issued, but you can make changes to the closing disclosure. And if one of these 3 items occur, then you have to start the new 3-day waiting period over again. So is there ever a waiver of the waiting period? I can tell you it's very rare. The time period, however, may be waived or altered for a bona fide personal financial emergency, which is very rare. The consumer must waive this timing requirement in writing, and a pre-printed form may not be used for this purpose. A bona fide personal financial emergency would be a situation where the consumer must have the loan consummated for a personal reason, and it would be determined by the facts of the situation, such as preventing the loss of a consumer's home due to foreclosure. That would be an example of a bona fide financial emergency. So once the closing disclosure has been issued and is complete and is accurate, then the settlement agent is responsible for providing the seller's copy, and they can meet that requirement by providing a copy of the borrower's closing disclosure. However, if the settlement agent creates a separate seller's transaction closing disclosure, then the settlement agent must also provide a copy of the disclosure to the creditor. So we're going to talk about tolerances, which is now called variances. And there's three specific tolerance areas which we're used to right now. We have our zero tolerance, our 10%, and our no limit tolerance. And if a fee is assessed at closing in an amount greater than that which is disclosed on the loan estimate, then as a general rule, it is not considered disclosed in good faith. And to avoid this, a lender and broker will have to abide by estimates that are provided, or the fee will have to be a type that falls in a limited exception. And we're already very familiar with this rule with the existing GFE. The rule provides for the same RESPA tolerance categories that we're familiar with, but with some very important changes that tighten the tolerance for some fees. So the tolerance categories continue to be zero tolerance, which cannot increase at closing, our 10% cumulative tolerance, which is a category that may not increase more than 10% aggregate at closing, and then our no tolerance, or what I like to call our no limit tolerance. And these fees may increase at closing, but are subject to good faith requirements. So the concept of changed circumstance continues the same as it is today. A changed circumstance is usually an event that's initiated by the application or out of the lender or credit's control, and it requires the delivery of a new loan estimate or a revised loan estimate. In our zero tolerance category, lenders are not permitted to charge borrowers more than the amount disclosed on the loan estimate under any circumstance other than changed circumstance that permit a revised loan estimate. So zero tolerance charges include charges paid to the lender or an affiliate of the lender, required charges paid to the mortgage broker or its affiliate, and charges paid to third-party service providers for which the borrower was not permitted to shop. And then finally, transfer taxes. So one of the biggest changes is for appraisal, for inspections, for credit reports, and for tax services. Specifically, those areas are going into the zero tolerance. So they have to be disclosed accurately on the loan estimate. And if there is a change in circumstance, is the only time that those fees can change. But the same rule applies. Doesn't mean you can increase anything unless it was increased only by a change of circumstance, period. Next area is our 10% tolerance, and these are fees that are paid to an unaffiliated third party if the lender permits the borrower to shop for a settlement service provider that is on the lender provided service provider list. So these are all of the areas that are on the service provider list that you provide to the borrower. That falls into the 10%. So if they are allowed to shop for it, it goes into the 10%. If they're not allowed to shop for it and you select it, there's zero tolerance there. That's the easiest way to remember it. Then we have our no limit tolerance or variances, and so there's certain fees and charges which is a good faith standard as far as what that is, disclosing it on the loan estimate. These charges are considered to be provided in good faith, and that's why there's no limit. These include prepaid interest, property insurance premiums, amounts paid into escrow, impounds, reserves, or similar accounts, charges paid to third-party service providers that's selected by the borrower, that not on the written list that you provide to the borrower. And then charges paid for third-party service providers not required by the lender. So that's our no limit tolerance, so these fees can go up. So those are the three different areas. And again, something we're used to. Biggest change is those items that a borrower cannot shop for. Everything falls under the no tolerance. So there's zero tolerance for anything that they cannot shop for. So that's a pretty quick run through on what we've talked about. There are a lot more details, obviously, as completing all the loan estimate. And it's important for you to train your staff on all the changes that are happening, as well as get training for yourself. So one of the things that's important to remember is that back in October of 2011, the CFPB issued their examination procedures, and it's the guide to how they will supervise and examine non-banks. So what the CFPB expects is that every regulated entity under its supervision and enforcement authority have an effective compliance management system that has been adapted to your business strategy and your size and your operation, obviously. But it's important to remember that each CFPB examination, and we're seeing this in a lot of state exams as well, will include a review and testing of components of your compliance management system. So they go through that in their examinations. We're seeing in a lot of the state exams, they're asking for your AML, anti-money laundering training, your fair lending training, additional training that you're doing. So we're starting to see that it is a requirement. One of the components is that you have policies and procedures. So the CFPB wants to make sure that you have internal policies, procedures, and controls. Your policies must be up to date. And this means no what we call MEC policies. Make sure that your policies apply to you. You should also study them, not just get them and put them in a desk drawer. You want to make sure that you've demonstrated that you have done training on them and implemented them. And you need to have all policies on all the federal consumer protection laws. This includes your RESPA, your TILA, your ECOA, your HMDA, your Gramm-Leach-Bliley, your anti-money laundering, your fair lending. And what are you doing as far as distributing those policies and enforcing? Also, you need procedures for underwriting, compensation, loan processing, and closing, especially if you are a correspondent lender for underwriting, non-delegated. You need to make sure you have all of your loan processing, your post-closing, everything you have as far as your policies and procedures in place. And again, it's important that you inform your staff and that they are trained and tested on all those policies as well. In addition, you need to have compliance training for your staff. And the CFPB, and again, we're starting to see this in a lot of state exams, that they're requesting and reviewing samples to the content of your training materials, to what testing you're doing on the training, and they also are looking for training related to new regulatory requirements, any new channels of distribution that you have. They will also request and review training developed as a result of any monitoring issues. So if you found that there was a particular error that was happening on a consistent basis, and that's really what the CFPB wants to see. They want to see that you can have your policies and procedures in place, provide training on those policies and procedures, as well as training on all of the compliance areas that you're required to adhere to, and that you're monitoring and that you're making sure that your staff is doing what they need to be doing. And one of the things is, and we talked about this for many years now, training is a focus. It's a big focus on what's happening in the industry, and it's not just enough to say you did it. With the CFPB and what many states want to see is showing that you've done it. And so that's what's really important, to have records in place that shows what training you have administered to your staff. We know the training is very important to the CFPB because in their examination guide, the word training is listed more than 120 times. So it's very important to have a training system in place. And really, it's beyond a compliance requirement. It's a necessity to train and educate your staff, and especially with the TRID changes that we have, which is the TILA RESPA Integrated Disclosure, to be able to get them trained on completing it, on the timing requirements, on all the areas that have an effect. This is one of the biggest changes. The regulation is almost 1,900 pages in length, so it's a really big regulation, and you want to make sure your staff is trained. And you want to think about how many areas you need to train your staff in. You need to talk about, obviously, the highlights, which we went through very quickly here in this webinar. You want to talk about the timing requirements. You want to train them on the business day definitions, on the new 6 items as application. You want to train them on completing the loan estimate, as well as the closing disclosure, and then obviously the limits on imposing fees. So there's a lot of areas that need to happen as far as training. And that's why we're introducing you to Morph Learning, which is an automatic gamification system. So Morph Learning is built with a gamification framework that has been inspired by leading experts from industry as well as academia. And gamification is the craft of deriving the fun and engaging elements that are found in games and applying them to real-world or productive activities. This process is called human-focused design, and as opposed to what we're used to in a lot of our compliance training or our CE training, which is a function-focused design, this is a design process that optimizes for human motivation in a learning system as opposed to pure efficiency, and it's unique to Morph Learning, but it's a proven winner by more than 100 global companies in highly regulated industries. And one of the things that we are looking at within the Morph system to be able to make the compliance training more engaging is one-click access to reports and dashboards. And so with the new system, this will allow you and your management teams to review an individual's performance at any given time. Morph Learning offers ready-made standard reporting and at-a-glance dashboards that you can use out of the box, or you can create custom reports and have them delivered via email. The system also provides certification as a proof of examination, and that's important if you are being examined at a state level or if you are having your investors request information, which we're seeing an increase on that. You can provide that certification to be able to review performance records at any time. The system also provides learning paths, so you can string multiple courses together. It has an effective interactive learning environment. Its secure web-based platform empowers your employees and partners to play, learn, engage, and achieve compliance goals anytime and anywhere. Depending on your company size and learning needs, Morph Learning provides a solution, and our package solution provides companies with a scalable online training system to help you accomplish your training goals. So whether you're a company with 2 employees or thousands, Morph Learning gives you a hosted online training cloud platform that's designed to power companies with an interactive technology-rich system to deliver the training you need to each employee. All Morph training systems include an administrative log where you can manage, track, and report your training. Our step-up pricing allows companies to have a system based on the size and need of their company, and we are not an all-or-nothing company. We've designed our system to be used by the very smallest to the largest of companies. Plus, we partnered with some of the best training companies out there who have content that's already developed, ready to implement to your staff through the Morph training system. So it's now really easy to have your own online university, create your own training, but also have the compliance training that you are looking for in order to stay compliant. In addition, we have some very cool features. We have personalized training for every individual that's aligned with your organizational goals. We have our Morph Coach, which is a personalized tutor and recommendation engine. It's a one-to-one virtual tutor, and it's built with advanced algorithms that learn how trainees perform. It also adjusts content and pace while providing additional content and examples and exercises in the areas where the trainee needs more help. So basically, the system tutors each trainee, catering to the trainee-specific training needs. We also provide optimal learning and retention framework based on cognitive and behavioral research with our Morph playbooks, or 3-minute or less personalized mini lessons from Morph Coach. So it allows you to make quicker training, make it available on the go. We have partnered with strategic compliance partners to develop our TRID training course. And so the purpose of the course is to enable loan originators, processors, mortgage personnel to learn the new requirements under the TILA RESPA Integrated Disclosure Rule so that they can perform their job functions as they relate to the changes. There are about 23 different modules, and again, the idea with the system is they're in shorter segments, so it's easier for employees to complete the training. We have 2 tracks to choose from. We have our operations track, which is for your operations staff, and we have our sales track, which is for your sales staff. So the sales track will focus on what your sales staff needs to know about the new requirements, such as the definition of application, timing requirements for the initial disclosures, and then obviously timing requirements for the closing disclosures. The operations track will include operational requirements. So what they need to know as far as post-closing, record-keeping requirements, things that are important on the operational side. Both tracks include how to complete instructions on the new disclosure. So go online to www.morphlearning.com and register for our complimentary old versus new disclosure comparison guide. And this is a guide that takes each of the new items that are in the rule that's important to you and your job. It quickly puts it into a comparison, what's new, what's different, and what's important. So go online to morphlearning.com, register for our complimentary old versus new disclosure comparison guide. And there you can get additional information on our TRID training as well as additional information on the Morph system. And your first step in developing and delivering your training program begins with a flexible, easy-to-use, secure, and powerful platform, and that's why we've developed Morph Learning. It was developed by industry training experts, and Morph Learning provides you with a complete enterprise compliance training system for your workforce and for your staff with patented technologies that speed course development, deployment, employee engagement, and centralized tracking and reporting management, regardless of where the training takes place, regardless of the size of your company. So on behalf of Morph Media and the Morph Learning System, I'd like to thank you for attending the webinar today. Make sure to log on to Morph Learning, get a copy of your old versus new disclosure comparison guide, and check out some of the compliance training solutions that Morph Learning can offer you.